All right, so employer healthcare costs, right? Fully insured, self-insured, level funded. How does all this stuff work? And you have lots of different variations about how all this works. So that's what I'm going to show you here real quick. And so I believe, I've been teaching people how to do this stuff for a long time, about 15 years, and I believe if you understand what happens at a fully insured dollar, then it'll help you to kind of get where you're going. So if you think about it, when you're paying $1 to an insurance carrier, you start to just go, all right, where's that money going? All right, so we've got a percentage that's going to taxes. Handwriting's terrible. All right, so, but you get the point. So now that's different in each state. It's called a premium tax, and we're just going to be very conservative. We're just going to say it's 2%, right? Then we have commissions. All right, so commissions are going to range in different products, and sometimes they pay what they call a PEPM, a per employee per month, and sometimes it's a commission or a percentage commission. So in other words, you can say maybe it's about 5%. And then there's a section that's called retention. All right, so again, backing out, what are we talking about? We're paying $1 to an insurance carrier. So what are they doing? And so 2 cents is going to go to taxes, 5 cents is going to go to the consultant to get them paid. And then there's going to be this part that is what the insurance carrier retains. All right, and then the rest of this is claims. And we're talking about a fully insured medical plan at this point, right? And so it's easiest to think about it in terms of a group health insurance policy for an employer, because obviously an individual is not going to be thinking about being self-funded or anything like that. And so the rest is claims, is medical claims, is pharmacy claims, right? And so this is going to come up to somewhere around 75%, really 70 to 75%. And then the rest of this retention ends up being everything the insurance carrier is doing. Now people will go, wait a minute, Mark. After the Affordable Care Act, there were medical loss ratio rules that had to be. This is you know the old shell game? You know, just you're moving around, you can't figure out where the ball is, but this guy already, this is a little bit like this. Because if I pay you, you know, in other words, if I pay out $75 or 75 cents, and then someone sticks 15 bucks in my back pocket, I didn't really spend 75 bucks. You know, and a lot of you would go, wait a minute, that's a kickback. Yeah, that's right. That's how that works. And there's lots of this stuff that happens inside this. It's not worth going into that whole thing. And so, again, we're trying to think, all right, we pay $1. We're trying to figure out, do we want to be self-insured? A lot of people, you know, talk about this. Should I be this? What even is it? But really, so what are we talking about? We're really talking about this piece of it, these pieces, because the claims kind of are what they are. The first guy that I worked for in the employee benefit business when I worked for Marsh & McLennan Companies, he'd say, Mark Combs, let me tell you something. Claims are what they are. It does not matter what the medical plan is. If somebody gets hit by a bus, they just got hit by a bus. It does not matter if you're fully insured, if you're self-insured, they just got hit by a bus. So there's going to be certain claims that happen, and there are ways to impact that, but overall, the claims are going to be what they are. And so you have to think, okay, well, why would anybody want to be self-insured then? All right, well, you might remember this thing if you paid attention in statistics class. And think about this as being average healthcare, expected healthcare cost for somebody, all right? In different areas of the country, it might be different amounts. Let's just say it's $7,500, right? $7,500 of medical and prescription drug costs that a person's going to have in a year. And then there's what they call standard deviations. So they could end up having less than that or more than that by a certain amount, which is a mathematical term. And it ends up being different standard deviations. Well, the longer that you end up doing this and the larger that you end up becoming, the longer meaning the more claims history you have and the larger of an employer you are, what you find is that you start to mimic this normal curve distribution. What does that mean? It's a big fancy way of saying we can predict this crap. And so if we can predict this crap, why the hell do we want to pay someone this amount of profit to actually insure it? Why don't we kind of get into their pockets a little bit? And so when you end up becoming self-insured, you go, no, I don't want to do this. I want to do this a whole lot different. So the first thing that's going to happen is that these taxes, it used to be the taxes almost all went away. There's still some, We're not going to go into the PCORI and all things because of the Affordable Care Act. There's still a little bit, but not nearly as much. And so this ends up being minimal in terms of a percent. The next thing that happens is that the commissions, now first of all, commissions, this is just me. I've been in employee benefits for a very long time. It's the days have come that we need to be fee-based. All right, so when I pay an accountant, I pay them by the hour. I know what it is that they're going to do. When I pay my attorneys, I pay them by the hour. I know what it is going to do. It's really the right way to do it. And so I strongly suggest to people, think about that. Think about, how do I convert? How do I make sure that whatever I'm paying, pay a commission, if that's fine, but know what it is and know what you're actually getting for it, like in an hourly basis, what work is actually happening, so it's not just a commission kind of a deal. But this is typically going to shrink because people on a self-insured group. And then what happens is that you're going to hire someone to do this stuff that an insurance carrier typically does, right? They just pay the claim. So you're going to hire a third-party administrator to, when they get the bills from the insurance carrier, from your plan members on your healthcare plan going to the doctor, they're going to send them the bill and they're going to pay it. And then they're going to send you a bill. And you're going to still have the claims. What you're going to find is that you're freeing up money, all right? So if you remember that graph here, we free up money for claims. And how are we freeing up money? We're freeing up by cutting out some premium tax, by minimizing the amount that's going to be paid to a consultant, and also, these are still important. I'm not saying consultants aren't important. If you're going to do this, you don't need to do this on your own. These guys are, the good ones are fantastic at this. Work with them. But then we're getting into this profits of the insurance carrier so that we're not paying them to do something that they're not necessarily doing. And so you start going, all right, well, what are the component pieces? Then we start breaking out being fully insured and self-insured. So what are the component pieces? What do they do? Well, they answer the phone. Theoretically, my insurance carrier rarely answers the dang phone, but theoretically they answer the phone. They set up networks. They send you cards. They're going to do lots of things like that. They're going to pay your medical claims and your pharmacy claims. And what else are they going to do? They're going to buy certain insurance internally. And so you go, wait a minute. They might do it or they might not do it, but there's really two risks, right? If you have 100 employees or 1,000 employees, doesn't matter. There's two major risks that you have. You have a risk that is specific to Mark Combs. Mark Combs gets hit by a bus. All right, that's a specific risk to me that the claim is $500,000. You might go, well, if Mark happens to be walking with Trent and Brian, and then I had 3 employees, they all got hit by the same bus, it's $500,000, that's $1.5 million. I can't afford that risk. You're right. So what you end up purchasing is some specific reinsurance that you're only going to pay X amount. Now there's different levels that you will set that at. It might be $50,000, it might be $500,000, depending upon how large you are as an organization. The second thing isn't that a specific risk that one person has a major, huge claim. It's an aggregate risk. Maybe a bad example, but everybody gets the bird flu, right? So it was $5 grand for everybody to get whatever they had to get, the drugs, and they got all healthy from it, and that's fine, and no one had any major issues that were costing tons of money, but from a financial perspective, it was catastrophic because in that normal curve distribution, you're way out there from expected cost on each person. And so they buy insurance. Now, they might layer that off in different ways, and that's what it gets pretty complicated in that, but you're thinking about it from an employer's perspective, fully insured versus self-insured. That's what you're looking at. You're recreating your own insurance plan. And so when things happen good and the claims end up trending out really well, then great. The claims don't happen. The profits don't happen to the insurance carrier. You actually keep that money. Here's the major thing, though, that when I always talk to people about this is that no one's going to pay your claims but you. There are no free lunches, period. It's like I'm having a conversation with my kids. I am using their washable markers right now, so I might as well be having a conversation with them. No one's going to pay your claims but you. Now, if you're fully insured, let's say you blew up that plan and you paid in $1 million of premium, but your claims were $2 million. What do you think is going to happen at renewal? They are going to get their money back. Right? And so they're going to catch up. It's going to catch up. And you're eventually, over time, going to pay your claims. And so now, if you're 20 employees, 30, 40 employees, 50, 75 employees, small organizations, It's a little bit more dynamic than that. There are things called level funded products to where they'll essentially create this self-insured plan, and then they'll figure out what it's going to cost, and they'll go, $1.2 million, we're just going to bill you $100,000 a month, and you just pay them $100,000 a month, just like you normally would. And at the end of the year, you go, do I have any money back or not? And so it's a simplistic way for people to get involved with that as well. But ultimately, what you end up having to do is focus on the claims. That's the beautiful thing about this, is that whenever you start considering, should I be fully insured or self-insured, you start getting into the claims. And there's only a handful of different things that you can do to actually control those, but the first step is understanding this dynamic of how the dollars even work.